Hello and welcome to Fidelity Connects and a very happy new year to all of you. I'm Pamela Ritchie. Though new beginnings abound, will the market pathway lead to a continuation of what investors experienced during the last months of 2025? Bullishness remains for the S&P 500. However, many wonder if leadership within that bullish index might see changing of the guard. Do we see market breadth expand, for instance? If so, what are the investment opportunities to consider there? Do the less successful asset classes of 2025, namely Bitcoin and REITs perhaps, ride a pendulum swing back to the top echelons or stay put? What does guaranteed further IA CapEx spending, along with lower rates, brew for the global marketplace? We're very lucky to be joined by Fidelity's Director of Global Macro to dive into the state of affairs for 2026. Warm welcome and Happy New Year to Jurrien Timmer. Hello.
Hello, Happy New Year. Happy New Year to everyone watching today.
Delighted to have you join us here today. And we'll remind everyone joining us here that this discussion is available with live French audio interpretation as well. Jurrien, it's a new year. There are things that are come over from the previous year. I wonder if we might just sort of off the bat take a look at the discussion of oil quickly and leave it in the realms of oil, because there's a lot going on due to the Venezuelan developments over the course of the weekend. But for oil specifically, the global markets, its place within it, how do you frame this?
Yeah, well, so oil is obviously a big part of the commodity complex. And actually, if we pull up slide 2, we can see the 2025 leaderboard. And, you know, what happens to oil here? I mean, it's not really up that much. It's at $58 is WTI. But the commodity complex, which has done all right, remains one of my sort of favorite uncorrelated assets. And obviously, the news out of Venezuela was, pretty shocking, especially for someone like myself who grew up in Aruba. It's like Venezuela is like in our backyard. It's certainly par for the course, and it's a hell of a start to 2026. But I guess the thinking is that Venezuela has one of the largest, if not the largest, oil reserves, and if that becomes a subsidiary of ExxonMobil or something like that, more oil will be pumped, and it will create more energy independence for presumably the U.S. or North America. So, in that sense, it's hard to see something overly bullish for the price of oil happening if those reserves are indeed tapped in the future.
And in theory, provide some version of stimulus, actually, if it's cheap oil that you're running an economy on.
Yeah.
Okay.
Exactly.
There are implications all over the place. We'll get into those probably at another time. But just to sort of begin with what is continuing from last year, because a lot of pieces of the story seem to be a continuation. I mean, it's just a calendar year in the end. It's just a changing of the actual calendar. It doesn't mean the market fundamentals change. What do we see from last year coming this way?
Yeah, so again, slide 2. The first half of last year obviously was about the tariff tantrum and, pricing in sort of disaster, trade war, a capital war, all kinds of unknowns. And we still have a lot of unknowns, of course. But then in the second half, we got a pretty good trend where the markets, rebounded obviously very strongly from the April 8th low. And the rest of the world, ex-US equities really participated in that. And as you can see, Europe, EM, IFA, Japan, all have posted very good returns, better even than the US. And they've done that in both US dollar terms and in local currency terms. So it is a very broad-based rally. And so you look at the chart, right? Gold, international equities, US equities, even bonds put in a very respectable performance. So for a diversified portfolio, we had a lot of tailwinds last year. And so I don't know that we're going to continue to have all of those tailwinds. I do feel strongly that non-US equities will continue to do well. And beyond that, as you mentioned in your opening, it will be, I think, for the US, a question of can the broadening be a bullish one? I mean, clearly the consensus views right now are that the US is going to run things hot here, right? We have this fiscal stimulus, and we have potentially we already have a somewhat dovish Fed and potentially even a more dovish one. And so that's going to run things hot, and that should unleash kind of the 493 of the S&P. But will that happen at the expense of the Mag 7 or in addition to? And I think that's one of the open questions for 2026.
One of the other questions I'd like to put to you that has to do with the international trade and the tilt and this whole discussion there is, I mean, a lot of EFA shares and international companies have already seen a huge run up. I guess the question is one thing that they're cheaper for sure, but is there still room for them to gain here, and roughly by how much?
I think so. So if we go to slide 7, that's a chart of the MSCI EFA index. So these are non-US developed markets, mostly Europe and Japan. And, that's a nice looking chart, right? So we broke out of this 15-year resistance line, about 6 months ago, and it hasn't looked back ever since. And you see the momentum curves below; those are positive. And so that EM has done very well also. But for me, the big story, or at least one that I can really kind of hang my hat on, is the EFA story. And if we go to slide 6, I'll show you why. I always talk about the discounted cash flow model. So obviously, earnings growth is very important, but how much of that earnings growth investors get to keep, if you will, I think is even more important. And so the payout, which is dividends plus share buybacks, that in the US has always been very, very high, around 90%. More recently, it's been closer to 75%. So the payout has gone down as a percentage of earnings. But in EFA, it's actually done the opposite. So in this chart, I show the 5-year growth rate, the CAGR, of the payout by country and region. And for the US, it's a respectable 10%, and nothing wrong with that. But EFA's at 12, Canada is at 13, India is at 14, Japan's at 19. And so we have a big part of the world actually really competing with the US from a DCF standpoint in terms of how much of the earnings story gets returned to investors. And as you mentioned, this is happening at the same time that EFA and EM are trading at 15, 16 times earnings, while the US is at 25. And so together it provides a very compelling narrative. And again, EM is part of that, but EM generally has a much lower payout ratio than developed markets for obvious reasons, because they are emerging companies. They tend to be more dilutive rather than retiring shares. But that doesn't diminish their story. It's just that for EFA, I can really point to something and say, that's a big thing, and it seems to have legs.
Yeah, it's absolutely fascinating how that ultimately works. And so in terms of portfolio construction, which is not exactly what you're providing us with each week, but just sort of that question of the barbell and the approach to making sure that you have the appropriate exposure to US tech and to essentially the Mag 7 or however many numbers you want to put after that at this point, but plus an international exposure. Is that still one of the ways of looking at things?
Yeah, that's still my solution to the concentration risk in the US, right? So the concentration risk, 7 stocks being 30 to 40% of the market, is great when those stocks are going up, right? And you have all the passive investments that are just piling in there and elevating those stocks even more. So it's great on the way up. But at some point, I mean, maybe not anytime soon, but at some point you could argue that those stocks might be overloved, maybe overvalued, maybe their earnings story starts to fragment, maybe the EI stuff ends up being kind of a cannibalistic thing where not all of them win and some lose and some win. Again, this is all speculation on my part, but if you're just a totally US-based investor, how do you navigate that? Are you going to short the Mag 7? So let's say you switch from a cap-weighted index to an equal weight, or you go down cap, or you go out of growth into value. To me, all of those are very risky moves, because then you're betting against the engine that has propelled the markets over the last 10 years. But if you're a more globally oriented investor, you can just say, okay, the US has dominated the scene since 2014 or so, but now the rest of the world is competing. at much better valuation. So they have a lower hurdle. And so for me, a global portfolio, and we can throw EM in there, but I like IFA the best just because they have gotten the religion there on maximizing shareholder value. So a barbell of S&P cap weighted and IFA to me is a very good way to manage against concentration risk while also capturing opportunities that are happening in the rest of the world after really being dormant for the last 10, 15 years.
It's so interesting because the word resilient was something that was used particularly for U.S. markets. I mean, maybe it extends, and that's really my question, the extension of the resilience. For U.S. markets to plow through everything from wars, geopolitical overlays, new political realities, and so on, the markets were resilient. How do you know that the global markets, which frankly have been out of the picture for the last decade or so, are just as resilient? Because there are still geopolitical overhangs to plow through. Those aren't gone.
Yeah, it's a great question. And, the U.S. has been very resilient. And we can go to slide 5 and just show you that the 5-year earnings CAGR is now at 14%, which is about the highest it ever gets. And that will be a conversation for another show to say, to think about what happens after you reach peak earnings like that. But, ultimately the fundamentals win, right? And the fundamentals are earnings, the payout of those earnings, and interest rates and the risk premium. And so those are the 4 components of a DCF model. And for the US, the earnings has been very good. The payout has been pretty constant or stable at 75%, so that's fine too. The risk-free rate, the 10-year Treasury yield is at 4.16, which I'm still very much surprised at that it's this low. So that's pretty benign. And the equity risk premium, which is like a sentiment indicator, is around 4%. And that's below average, but it's not like crazy below average, right? So the U.S. is on a pretty sustained path, and I think the hurdle is high to keep the kind of gains going that we've had. But again, there's nothing in that picture that tells me that this is something that's completely unsustainable or is going to break. And so if we then take the conversation to non-U.S. markets, right? So in IFA, the risk-free rate is pretty low, in Japan as well, and in EM, they tend to be higher. The earnings growth numbers are pretty good, right? For IFA, the expected earnings growth is about 9%. In the US, it's about 12%. In EM, it's about 14%. The risk premium in IFA is around 5, so better than in the US. And in EM, it's more like 6 or 7, which is typical, of course. Yeah. EM tends to have a higher risk premium. So none of these markets, to me, have a component in their DCF sort of valuation structure that says this is clearly not right. The market is like, smoking something. There's nothing in there that tells me this is an accident waiting to happen. But like you said, geopolitical tensions obviously are always there. Russia, Ukraine, and the question now is whether China will look at what the U.S. is doing in Venezuela and say that gives us license to take Taiwan, and what happens then. And so there obviously are components there that are going to affect maybe all markets, but certainly specific markets in specific regions.
Okay, so the resilience can sort of hold up in theory to sort of plow through some of those issues. You mentioned peak earnings. Can we go there a bit, even if it's a broader conversation next week? You have a great chart on this discussion.
Yeah, so well, let's go to slide 4 first. So this is the market cycle since the October 2022 cyclical bottom. And you can see the price action has been very, very strong, about 100% over those 3+ years. It was initially fueled by PE expansion, which you can see in the middle panel. That in 2025 has now taken a backseat to earnings, which are, as you can see in the right panel, have really accelerated. And of course, the AI story is part of that. The Mag 7 story is part of that. But it really is a broad-based earnings advance. And it shows you what's happening with CapEx from the One Big Beautiful Bill, et cetera, et cetera. So what I like is that the baton was passed really as long ago as 2024, from being purely driven by PE expansion to something more of a combination of PE and earnings, and now in 2025, almost entirely earnings. That doesn't mean that the PE isn't too high, but but the contribution to the returns are not coming from multiple expansion. And so if we then go to slide 5, again, this is the chart that shows the 5-year CAGR of earnings, which is the blue, and the 5-year change in the PE ratio, which is the pink. And there's a little bit of a base effect story here because it's now 2025, or it was a few days ago. And so you're measuring back to 2020, which of course was COVID. But from 2020, the PE is actually down slightly, and the E is up, 14%. So it is a very, very positive picture. But again, with the caveat that it never really gets better than 14%. But again, that doesn't mean the markets are going to fall off a cliff, because this is the 5-year growth rate. We can go from 14 back to 10, and there'll be nothing wrong with that picture.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
It's incredible. Take us to the U.S. dollar story a little bit, and we'll get into probably the discussion of what the Fed needs to do and what they're likely to do and some of the influences swirling around there. Did we see the discussion of sort of U.S. dollar trajectory continuing to be lower? Did we see international investors, I don't think we did, sell treasuries essentially to move assets or move their money away from a currency that is projected to be on a downward turn here?
We really have not. And, remember, when was it, in March of last year or early April, of course, we were all pondering, when we saw those boards with the tariffs that the president was holding, we were wondering, are we going to have a trade war? And if we have a trade war, is that going to turn into a capital war where foreign investors, either private or institutional or governments, will withdraw their U.S. assets as a form of protest against what I think probably many of them would consider an unfair, trade policy. And we really have not seen that. We have not seen it at all on the equity front. Flows have continued to be positive. And I think that has more to do with the Mag 7 and the AI boom, which of course has somewhat of a home base in the U.S. So I don't think it's necessarily foreign investors feeling patriotic about the U.S., but it's just they go where the profits are, as well they should. But even on the bond side, we really have not seen any withdrawals. It is true that the Chinese central bank, that its holdings of treasuries has continued to come down, but it's been doing that for a long time, and I think that's a strategic thing rather than a tactical thing. So we have not really seen an exodus, and as a result, slide 13, we can see that the dollar really hasn't done anything over the last 6 to 9 months. I mean, it fell earlier last year as investors were afraid of that, and then it's been sitting in a range. And if we look at the nominal effective exchange rates by country, this chart goes all the way back to the 1970s, you can see that the U.S. is pretty much the strongest currency other than the Swiss franc. And of course, Switzerland has its whole unique set of things going on. But the dollar continues to reign supreme, even though another reserve currency, namely gold, is taking market share away. But this chart shows all fiat currencies, not gold. But we can show actually slide 14 real quick. And I've shown this chart before, that since the financial crisis, central banks have been adding gold to their portfolio. That's the bottom panel there, and of course it's been a lot of China and Russia and other emerging markets. And you can see in the pink line that the value of gold, and these are at national valuations, not at the market valuation, is now above the value of all euros as a reserve currency, and getting towards. I mean, it's still a long ways away, but it's taking market share from all fiat currencies, and it's now the second place after the U.S. dollar.
It's really interesting that the euros are being replaced so much by gold. Just as because you would think it would be the other alternative.
Yeah, well, the euro has been fine. It's just that the euro was in the laser sights of gold, just because their market values are similar. So it's not, gold has not gone up at the expense of the euro. It's just going up at the expense of all fiat currencies.
Can we talk a little bit about Bitcoin? It was a rough final quarter for Bitcoin, certainly. I mean, there were even, they go so far as existential questions get asked and then it switches back. But what are some of your thoughts ultimately on where Bitcoin goes in the year to come?
Yeah, so we can go to slide 16, and I find it fascinating, right? So I mean, I'm into Bitcoin. I've been following it very closely for the last 5+ years. I've done a lot of research on it, but I also like to follow what sort of the Bitcoin natives, if you will, say about it. And in recent years, a lot of focus was put on the halving cycle, right? So you got that 4-year cycle where the growth rate of supply gets cut in half, and that tends to produce these massive rallies. And then following that, you get these kind of winters where the price of Bitcoin goes down, 80% or something. And we are at the point where that should be happening, and maybe is happening, not 80%, but we've gone from 126 to 80, and we're at 94 right now. And at this point, these Bitcoin natives, if you will, are saying, well, the 4-year cycle is dead. We're now in a super cycle, a structural cycle. And I get a little skeptical when I hear that. I do agree that the halving cycle matters less and less and less as more and more coins have been minted, because the delta, the change in the production, really doesn't have the same effect as 5 or 10 years ago. So I do think that maybe that curve flattens out, and we can see that in this chart, right? The blue line is the power law curve. The pink line is the S model, the S curve model that I created based on the internet adoption curve. And we're kind of following that S curve model pretty closely. And so in that sense, I think Bitcoin is probably near fair value. 65,000 would be kind of a place where I would want to buy more, because that's the previous high. But if we go to the power law stuff for a moment on slide 17, this is really fascinating. And if you go on Twitter or X and you read some of the Bitcoin stuff, there's a lot of very strongly held views here that Bitcoin is following this immutable power law, which it has, right? So in this chart, I'm showing the price and the time on the horizontal, but expressed on a logarithmic scale. So you get this straight up line, and Bitcoin has followed that beautifully, regardless of what the sample size was that you used to create the chart. And so if you take that regression line, which is the blue dotted line, and then you kind of create a parallel line under all the lows, that becomes the power law sort of support line. And that is, to me, is the real line in the sand. It's at 47,000, so it's really far away at this point. But to me, if that line was ever to be broken, you could argue that the whole power law has been rendered obsolete. I don't expect that to happen, but that to me is kind of an interesting way of thinking about where would you want to buy Bitcoin if you don't already own it? What would need to happen for the bullish thesis to be proven wrong, and things like that. So if we go to just slide 18 for a second.
So the power line, sorry, is the power line is the floor. Is that?
So if you take a parallel power line, and on slide 18 we can see it. It's the same chart, but now the time axis, the horizontal axis, is on a natural, like a normal arithmetic scale rather than a log scale. So now Bitcoin looks more like the way we think about it. And again, I think Bitcoin probably is going to take a year off because that is where we are in kind of the 4-year cycle. I think 65 will probably hold. And the more time we're there, the closer we'll get to that trend line on the power curve. And so to me, again, I don't want to make too many predictions here, but if 6 months from now or 9 months from now, Bitcoin is sitting at 65 or 70,000, to me, that's going to be very compelling as a place to say, okay, another winter has passed, and each winter gets less and less cold, just like each summer gets less and less warm when it comes to Bitcoin, because it does follow that flattening upward slope.
Okay, it's like the environment. Yeah. Let's finish, if you don't mind, with what the Fed needs to do over the course of the next little bit. This is sort of one of the big stories of this year, the leadership change. But ultimately, if we look at the minutes, it's sort of the division story, I guess, is almost a bigger story. The minutes showed that there were big divisions on how many rate cuts essentially need to happen in 2026. Take us there and just your thoughts for how we should follow this story in 2026.
Yeah. So let me start with slide 8 and just give the kind of the economic growth backdrop. We know that inflation continues to be kind of stubborn at around 2.5–3%. So it's not terrible, but it has not reversed any of the big inflation we saw, after COVID. And at the same time, the U.S. economy, even though we look at the labor numbers and they're kind of soft, and obviously we have a big affordability crisis for the younger generation in this country. But if you look at actual GDP minus the potential GDP growth, that's the bottom panel here, the output gap, so the economy is running ahead of its potential, is the highest now since the year 2000. So that's 25 years. So the economy, I wouldn't say it's running hot, but it's running above its potential, which generally should mean that it's going to be inflationary. And of course it has been, and maybe the AI story changes that, we don't know. But if we take that as a template and then go to slide 9, enter the Fed, and the Fed, of course, raised rates significantly back in 2022 into 2023 and has been dropping rates since then, so 175 basis points since its peak of 5 3/8. The various iterations of the Taylor rule, which I show in the top panel here, are all supporting lower rates, but they are just not supporting the degree of how much rates have fallen and how much the market expects them to keep falling. So the market is expecting the short rate to go down towards 3%. The Fed seems to be in agreement over time. We obviously are going to have a leadership change. The Fed, as you mentioned, is becoming more fragmented. You have the status quo academics on the Fed who want to look at things like the Taylor rule and say, things are not in order yet for us to go to neutral because inflation is above target. And then you have sort of I hate to say it, like Trump loyalists who are going to always push for lower rates because they want to score political points. And I think that will create some tension at the Fed, especially when the new Fed chair comes in. And you're going to see more fractured rate outcomes where the FOMC will vote, but it won't be unanimous. It won't even be like one dissent. It might be like a Supreme Court ruling, like a 9-6 or something like that. And I do think that that's very likely to happen in the coming few years.
Okay, it's fascinating. Jurrien Timmer, no one else would we like to start off the year with than you. Thank you for sharing your thoughts, your incredible graphs and charts, and we wish you a very happy new year to you and your family.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.